Most real estate investors are asset rich, cash poor. I am a prime example and I'm living it right now. So let me explain. So, a lot of real estate investors, if you're buying value add real estate and you're trying to grow your real estate portfolio, like what I'm doing, typically you're very asset rich, like you have a high net worth in terms of real estate, but in terms of your cash position, you're very poor. Let me explain. So, for my 26 unit apartment complex, when I bought it, it was a value add apartment complex. I put 20% down. I bought for $520,000. I was able to get roughly 10%, $50,000 in seller repair credit. So essentially, I put 10% down, which was 50K, which was great, right? That's how you kind of leverage a little bit. And from there, I had to renovate 26 units at $10,000 each, had to give a brand new roof, which is $30,000, and touch up the exterior, which is another $10,000. So roughly, it's around $300,000 that I'm pumping into this property to renovate it, right? So when I first bought it, I was grossing around $10,000 a month, right? So which is cash flow positive because my loan payment was only like $2,000. You know, property tax was $6,000 a year, $500 a month. Insurance was $1,000, a little over $1,000 a month. Property management was 8%. Water, trash was around $1,500 a month. So you're definitely cash flow positive, right? But what happens when you're doing value add real estate is you're going to start to renovate units. So whatever cash flow I do have, I'm taking that cash flow, I'm pumping it back into renovations, right? So I'm putting my own money in for renovation, but also taking any excess cash flow I have, if there's any, into renovations as well. But what happens, and what I always preach in my course, and what I always tell my students who buy apartment complexes for the first time, is the moment you take over an apartment complex, yes, when you underwrote it, you're cash flow positive. But the moment you take over, you have 5 to 6 tenants stop paying you, they move out, now your cash flow is gone, right? Let's say I was going to cash flow $2,000 a month and take that $2,000, reinvest it back into renovation. But if I have 5 tenants leave and they each pay me $500, I just lost $2,500 in rent. Now I'm breaking even, and now I have to put in money for renovation, right? So, when you have 5 tenants leave, what does that mean? You have 5 vacant units, and now I got to spend $10,000 per unit to renovate those units, which is $50,000. That's what I mean by asset rich, cash poor, because I'm putting my own money in to renovate the units. When the units are rented out, whatever cash flow I'm getting in excess is being used to renovate the apartment complex as well. So it takes about 2.5 to 3 years to stabilize an apartment complex if you want to go gradually, right? So what I mean by gradually is, okay, so I had 5 units that became vacant. I'm going to renovate those 5 units. It's probably going to take me around, 3 months to renovate those 5 units completely. New kitchen, new flooring, new bathroom, new paint, everything, right? Brand new everything. And then you pay contractor, there's delays, whatever that is. So I'm pumping in $50,000, right? So that's what I mean by asset rich, cash poor. I have this cash set aside, dumping it to renovate it. Once those are renovated, I rent those out. And then that increases my cash flow position. But then what happens next? Once I finish renovating those 5 units and they're rented out, now I need to vacate 5 more units, right? And renovate those units next. So the moment I vacate those 5 units, my cash flow goes back down. And now I have to put another $50,000 to renovate it, right? And then once those are done, I rent those out, and now my cash flow goes up. So you repeat that process until all 26 units are done, right? So so you're basically kind of like, for the most part, breaking even cash flow, maybe making a little bit of money, but whatever little money you make, you're pumping that money back into feeding the apartment complex for renovation. So that's what I mean by we're very asset rich, cash poor. And then we don't get our payday, we don't get our cash until it's all stabilized, all the units are rented at market rent. And if you decide not to do a cash out refinance and pull your down payment back and renovation costs out and continue to buy more, at that point, that's when you start to make cash flow, right? Like at that point, my apartment complex will be grossing 18K a month, and my mortgage is only $2,000, right? So at that point, and then once again, property taxes 500, insurance is increased to maybe 1,200 a month. property management is 8%. Water is still around water and trash still $1,000. There's random maintenance issues, but at $8,000, 1,800, if 10,000 goes to expense, I cash flow $8,000 a month. Right at that point, I am now cash rich. But if I do a cash out refinance, increase my loan amount, increase my interest rate amount because interest rates are higher, my debt service monthly is higher, it cuts down my cash flow. But I pulled out my down payment, my renovation costs, additional money on top, tax free, and use that to buy my real estate. So I just cashed out my cash flow, took the equity, and now I'm buying another value add apartment complex. And now I am cash poor again, asset rich again, right? Or if I decide to just collect the cash flow, but you could use that cash flow to save again to buy another piece of real estate, right? So that's what I mean by like asset rich, cash poor. Like, um, if you keep on taking whatever money you make and then you reinvest it back into renovations, if you reinvest it back into buying more real estate, you just accumulate a bunch of assets, but you're always in a cash poor position. So, that's just kind of the reality of it. A lot of people don't really advertise it, but, I'm going through it. Like, I own 90 units and I'm doing 3 value add real estate deals. And, I basically am funding the renovation, the down payment through my single family homes that have a lot of equity in it. I did cash out refinances. I got HELOCs on them, pulling out my equity to then buy more assets. So because of that, I'm like, despite all the rental income I get, it's all being pumped back into renovations. It's being pumped back into buying more real estate. It's being pumped back into paying down my HELOCs. It's being pumped into paying down my other loans that I did during my cash out refinance. So that's what I mean by like you're asset rich, cash poor. So there's a balancing, right? So like you don't want to be too asset rich and too cash poor that you can't sustain your portfolio. That's what led me to like, you know what? I need to sell one of my assets, which is my mobile home park, cash back, get back some of my money, and then use that money to stabilize, pay down my loans, pay down my HELOC, continue renovating my apartment complex, and then stabilize that portfolio. And once that portfolio is cash flowing, take whatever is excess from the sale and then use that to buy my next apartment complex. Right. So you constantly have to be balancing. Like I went too extreme. I bought too many assets. I was too cash poor. But now I want to get back some of my cash, right? Stabilize it, sit in a good cash position of at least $250,000 in my bank as a reserve. And in my other video, I talked about you need $300,000 to buy your next one. Put myself in a position to buy another apartment complex, and then once the opportunity is there, I will strike, and then I'm gonna be cash poor again, right? And asset rich again. So it's a constant phase where as you scale, you're gonna be asset rich, cash poor. Once you stabilize, you'll have asset rich, and then you'll have more cash rich, right? And then once you're in a cash rich position, that's when you start saving money again. And then if you just want to sit in a cash rich position, it's fine. You can stop. You don't have to buy any more real estate, retire from your W-2, enjoy life, right? Or if you want to continue to buy real estate, once you've built another big enough cash position of $300,000, then you'll buy another piece of real estate, become asset rich, cash poor again, and then repeat the process over and over again, right? So you have to understand there's different seasons of life. When you're growing and you're scaling, you're going to be asset rich, cash poor. When you're stabilizing, that's when you start to get your cash. Or when you start to offload one of the properties and you cash in, that's when you become cash rich. And you save up again for another season where you're going to be asset rich, cash poor. So it's like playing offense and defense, right? There's a season where I'm playing offense, I'm scaling. There's going to be a season where I'm playing defense, when I'm stabilizing and building up cash. And you alternate, right? Play offense, play defense, play offense, play defense, right? You may hit a point where you don't want to play offense anymore. You have enough wealth to hit your goals, and you're just playing defense. There's nothing wrong with that, right? Like right now, I'm playing defense. And I will not play offense until it makes sense, until my apartments are stabilized, until I have a decent cash position and cash reserves of $300,000, until I've paid off, some of my other investments that I'm doing. Right at that point, then I may invest again, right? Or I may just sell off one of my single family homes, cash out that cash to make myself in a better cash position to then buy another apartment complex, right? So you have to constantly reevaluate your portfolio, constantly reevaluate your goals, constantly make pivots and moves based on your new goals and how you want to pivot to then make your next move, right? So this is what's nice about having a mentor, having a course, learning from somebody who's a couple steps ahead of you. And that's what really inspired me to creating the Making Multifamily Money course, right? And as well as the coaching that I provide and the mentorship that I provide, is because you need somebody who's been there to give you that perspective on how to create your goal, right? Like that's exactly what I did um, with my mentor. I had a mentor as well, and I did coaching as well, or I had coaching. So it helped me get me to where I am today, helped me give me clarity to hit my goal. And now I want to do the same thing for other people because people don't realize like it's not as glamorous owning 90 units as you think. Being asset rich, cash poor, you're still like you need cash today in order to like do the fun stuff, right? Like if I want to go on like a nice vacation, I need cash today, right? But a lot of my cash is coming in the future. So I always focus too much money on the future, but I didn't focus enough on today. So that's what led me to sell because I need some money today to enjoy life today because I sacrificed for the past 10 years. So now it's time to reap some of the fruit of my labor, right? I've been planting seeds, I've been growing trees, and now the tree has fruit. I want to harvest some of the fruit and enjoy some of the fruit today while still planting for fruit to grow in the future, right? So that's what I mean. I massively scale. I played all offense. Now I'm playing defense. At this point, I want to enjoy. So, hopefully you found value from this video. Hopefully you understand what it really means and what's really like to own a lot of real estate. It's not as glamorous as people make it seem on YouTube. Not as glamorous as people make it seem on the podcast. There's a lot of sacrifice. You live very humbly. There's a lot of stress. You're constantly reinvesting your money back into real estate, so it doesn't feel like you're rich at all. Like I honestly feel like I'm poorer today at 90 units than I was when I owned two single family homes and had a high income W-2, right? Like I was just sitting there with a lot of cash every month, but I didn't own as many assets versus now I own a lot of assets and have less cash because I'm constantly reinvesting that cash. So there's a fine balancing act that you have to do and you have to constantly reevaluate. And that's the challenging part. When I was constantly scaling, I had no opportunity to pause, self reflect, and readjust. Now that I paused and haven't bought real estate for the past, year and a half almost at this point, now I had the clarity to reevaluate everything that I'm doing and then give me more clarity on my goal that I'm striving towards. And I realized that, you know what? Even after selling my mobile home park, if I just own my two apartment complexes, that's enough to hit my goal of $15,000 a month net cash flow once stabilized. So once I realized that, I'm like, I don't need to scale anymore. I need to stabilize. And once it's stabilized, I have $15,000 a month in cash flow net. At that point, I could just leave my day job, or if I don't mind working, take that 15K and save up for that next property, right? Save up for that next property and buy another one. But if I want to take like a 2 year sabbatical and travel the world, I could once I have 15K a month in net cash flow. So, it really got me to reevaluate things. Like, I don't need as much money as I thought. I don't need as much wealth. I was really big on like passing a bunch of assets to my kids, but honestly, my kids are going to have way more than I ever had. So, like, why am I working so hard to like pass off money to kids when they already have way more than I would ever have or inherit from my parents? Right? Like, and then plus, if you think about it, like I'm gonna inherit stuff from my parents, and then my kids are inherit from me, plus what I inherit from my parents, right? So like that's how generational wealth is built. So like I realized that like I didn't need as much as I thought. I read the book Die with Zero and was like, oh, it's true. Like why not spend the money today? Because money spent today is more enjoyable today versus money spent in 5 years, and I'm experiencing that now. So it's a fine balance of, enjoying the today, enjoying the present, but also building for the future, right? That's why I kind of view things in 6 to 12 months goals now. I used to look 5 years in advance, but now I do, 6 to 12 months goals. But before that, I had to look 5 years in advance because I was saving up for that, right? But now I finally hit my, 5 to 10 year goal of, buying this much real estate, of accumulating this much of a net worth, of accumulating this many assets, and to strive towards a certain, cash flow goal. So now that I hit it, I can kind of look at more short-term goals and like, hey, like maybe I just want to like travel. Like, hey, maybe I just want to like start a family. Like you have to constantly reevaluate your goals. So, hopefully you kind of got some insight as to what it's like to really own real estate and not be all rosy that people tell you like, oh yeah, you just buy some real estate, 2 years, you'll have enough cash flow to retire. It's not that way, right? Like you're going to be asset rich, cash poor. By all means, if I were to cash out all my real estate and just sat on all the money, I probably could leave my day job. And then, I could probably fund my lifestyle for 20 years. And that's enough. That might be enough for some people, right? And people can do that. That's nothing wrong with that either. So it really depends what your goal is. But the key is self reflection, right? And learning from those who have achieved what you want to achieve to get that perspective. Because I will say it's not as rosy as you think, and it's not as great as you think once you achieve it. So once again, please, please take this video seriously. Listen again multiple times so you understand the reality of what it's like to own real estate.